Ladies and gentlemen, are you ready for a week of impact in the metals markets? Silver just printed $86.82 on the Western tape. Intraday high near $88. That's a 6% move in a single session. Gold is at $5,158, up over $60 in 24 hours. And the mining sector is confirming the move with record free cash flow and earnings beats across the board. But that's not why I decided to record this video today. I'm making this video because in about 10 hours, Shanghai reopens. And when that happens, a market that has been closed for a week, accumulating orders, pent-up demand, and a price discovery gap, is about to collide with a Western market that just ran 6% without it. And that collision is the most important event in the silver market this week, possibly this month. I'm going to walk you through exactly what that collision means, what signals to watch tonight, and one specific number from the recycler market in China that tells you something the spot price cannot. Stay for that number. Quick disclaimer: nothing in this video is financial advice. This is education about market mechanics and price discovery across global exchanges. All right, let's start with what just happened and why it matters more than a green candle on a chart. Silver moved 6% in one session. For most asset classes, that's a week of movement compressed into hours. For the S&P 500, a 6% day would be front-page news globally. For silver, it barely makes the financial media scroll bar. And that disconnect between the magnitude of the move and the lack of attention it receives tells you something important about where we are in this cycle. The mainstream hasn't caught on yet. The move is real. The coverage is absent. And historically, that combination, big moves plus low attention, is the fingerprint of early cycle repricing, not late cycle mania. But here's the data point that elevates this from a good day to a structural signal. Western silver prices just caught up to Shanghai while Shanghai was closed. Let me say that again because it matters. The COMEX price closed the gap with a market that wasn't even open to trade. Silver rallied into a vacuum. There was no Shanghai bid pulling it higher in real time. There was no Chinese industrial buyer competing for metal on the tape. The Western market did this on its own, driven by its own demand, its own positioning, its own recognition that the price was too low relative to physical reality. And that raises the question that should keep every silver trader awake tonight. If the Western market rallied 6% just to meet Shanghai's pre-holiday price, what happens when Shanghai actually opens and adds its demand on top? Let me give you an analogy. Imagine two runners on parallel tracks separated by a wall. Runner A, Shanghai, sprinted to a certain pace before the holiday and then stopped, frozen in place while the market closed. Runner B, the West, was behind. During the holiday week, Runner B accelerated and caught up to where Runner A stopped. Now in 10 hours, the wall comes down. Both runners are on the same track, and Runner A wakes up with a week's worth of stored energy. The question is not whether there's a sprint. The question is how fast. Now let me show you the numbers, because this is where analysis separates from enthusiasm. Gold at $5,158.68, up $60 in 24 hours, a 1.17% move. We touched 5,176 at the session high. For gold to move $60 in a day at these levels requires serious capital rotation. This isn't retail buying. Retail doesn't move gold $60. This is institutional flow. This is central bank adjacent positioning. This is portfolio reallocation happening in real time. Silver at $86.82, up 3% on the day, with the intraday high near $88. And here's the structural piece. Silver's relative strength against gold today was pronounced. Silver outperformed gold by roughly 5-1 on a percentage basis. When silver outperforms gold during a rally, it tells you something specific about the nature of the buying. Gold rallies on fear. Silver rallies on fear plus demand. When both metals are rising but silver is leading, the bid isn't just safe haven. It's industrial. It's physical. It's someone who needs the metal, not just the exposure. And this is exactly what the 9th consecutive monthly gain in silver is telling us. 9 months straight. That's not a trade. That's not a momentum play running out of steam. That's structural repositioning. Month after month, the same signal. Industrial demand from solar and EVs providing a floor, investment demand from monetary stress providing the acceleration. And supply unable to respond because 70% of silver comes as a byproduct of base metal mining, and the primary mines are in secular decline. 9 months of deficits compounding, 9 months of inventory draining, 9 months of the physical market quietly asserting itself while the financial media looked the other way, platinum holding at $2,164, palladium pulling back slightly to $1,749, down about 1.2%. Honestly, after the moves we've seen, a breather in palladium is healthy. Markets that never consolidate eventually collapse. Markets that pause and digest are building a base for the next leg. That's just market architecture. Now, India. And this deserves its own moment because what's happening in India right now is historic. Gold on the MCX has reportedly crossed 160,000 rupees per 10 grams. Silver in India is converting to $85.76. And here's the signal embedded in those numbers. Physical demand at major hubs, India, Dubai, Singapore, is running at extreme levels despite these prices. Not because of them, despite them. When buyers accelerate purchases into a rising price, they're not chasing, they're securing. There's a difference. Chasing is emotional, securing is strategic. It's the behavior of someone who believes the price tomorrow will be higher than the price today, and that availability tomorrow is not guaranteed. When you see that behavior across multiple continents simultaneously, it's not retail FOMO, it's global physical urgency. Now let me talk about the elephant in the room, Shanghai. The Chinese market has been closed for the Lunar New Year holiday. It reopens in approximately 10 hours. And during that closure, we've received signals from the recycler market in China that are frankly extraordinary. Recyclers in China are reportedly offering the equivalent of up to $96 per ounce for silver. $96, while the Western spot price is $86. Let that number sit with you, because it tells you something the spot price cannot. Recyclers don't pay $96 because they feel bullish. Recyclers pay $96 because their downstream customers, the solar panel manufacturers, the electronics fabricators, the EV battery producers, need the metal so urgently that they're willing to pay a double-digit premium over the global benchmark just to keep production lines running. That's not speculation. That's desperation dressed in a business suit. And this is the number I told you to stay for. Because if Chinese recyclers are paying $96 while Western spot says $86, the gap tells you the real acquisition cost of silver in the world's largest industrial economy is $10 above what your screen says. That's not a premium, that's a confession. The screen price is underreporting reality by more than 11%. Now, when Shanghai opens tonight, that demand doesn't just appear on a chart, it hits the global order book. Chinese industrial hedgers, who were unable to trade for a week, have accumulated purchase orders. Manufacturers who need to lock in Q2 supply have been waiting, and they're not price sensitive in the way a speculative trader is. A speculator waits for a pullback. A manufacturer buys when they need the metal, because the alternative is shutting down a factory that employs 3,000 people. That buying pressure is inelastic. It doesn't negotiate with your chart levels. So what happens when inelastic Chinese demand meets a Western market that just ran 6% and is sitting near the top of its daily range? Outcome 1. Shanghai opens and immediately bids above Western levels. The premium widens. Arbitrageurs attempt to close the gap by buying Western silver and selling Eastern contracts. This creates additional buying pressure on the COMEX and London spot. Western prices get pulled higher toward the Shanghai physical price. The move extends. Outcome 2, Shanghai opens cautiously. Some profit-taking occurs after the holiday. The premium compresses slightly. Western markets interpret this as a breather. Prices consolidate. But the recycler premium tells you the underlying demand hasn't changed. It's just pausing for a session before resuming. Consolidation in this context is a loading pattern, not a reversal. Either way, tonight's Shanghai session sets the tone for the rest of the week. And the rest of the week includes Wednesday and Thursday's critical inventory reports, and Friday's first notice day for the March silver contract. And here's a dynamic that most Western analysts consistently underweight. Shanghai doesn't just set a price, it sets a floor. Because the Shanghai market is built around physical settlement. When an industrial buyer in Shenzhen buys a silver contract, they expect bars. They expect metal in their hands. They're going to melt it, paste it, solder it, and build something with it. That's fundamentally different from a hedge fund in Connecticut rolling a COMEX contract for exposure. One transaction ends with a product. The other ends with a spreadsheet entry. And when the transaction that ends with the product is willing to pay $96, that tells you the floor is set by manufacturing economics, not by financial sentiment. Manufacturing floors don't move down because a chart looks overbought. They move down when factory orders slow. And factory orders for solar panels, EVs, and electronics are not slowing. They're accelerating under government mandates worth trillions in subsidies globally. Let me connect these dots, because they're not isolated events. They're a sequence. Silver rallies 6% heading into the final week of February. Shanghai reopens with pent-up demand and recycler premiums at $96. First notice day arrives Friday, February 27th, forcing longs to declare whether they want metal or paper. Registered COMEX inventory sits at 88 million ounces against open interest that dwarfs it. And all of this is happening while the macro backdrop deteriorates into a stagflationary mix that favors real assets. Each of these individually is interesting. Together, they're a pressure system. And pressure systems don't ask permission before they move. Now, there's one more thing happening today that deserves attention because it confirms the cycle at a fundamental level. Newmont Corporation, the world's largest gold miner, just reported record free cash flow. When miners generate record cash flow, it means two things simultaneously. First, the metals prices are translating into real profitability, not just chart movements. Second, the companies that produce the metal have the capital to invest in exploration, expansion, and acquisition. That creates a positive feedback loop. Higher prices generate higher cash flows. Higher cash flows enable more production investment. But more production investment takes 5 to 10 years to result in actual ounces. So in the near term, the cash flow signal confirms the price trend without threatening to overwhelm it with new supply. The supply response is structurally delayed. The demand signal is immediate. And there's a subtlety here that most commentary misses. When gold is defying the dollar. Today, the US dollar is stronger. Normally, a stronger dollar suppresses metals prices. That's the textbook inverse correlation. But gold is up $60 and silver is up 6% in the face of dollar strength. When an asset rises against its traditional headwind, the underlying bid is more powerful than the macro resistance. It's like a boat moving upstream. If it's still making progress against the current, the engine is stronger than the river. And the engine right now is physical demand, institutional rotation, and central bank accumulation overriding the dollar's gravity. This is what veteran traders call a character change. For years, the playbook was simple. Dollar up, metals down. Dollar down, metals up. Algorithmic traders built entire strategies around that correlation. And now the correlation is breaking. Not slightly, visibly. When correlations that have held for decades start to fail, it means the underlying drivers have shifted. The old playbook is being overwritten by new forces that the algorithms haven't been programmed to understand. Physical demand from the world's largest manufacturing economies doesn't care about the dollar index. It cares about whether there's silver on the loading dock. And right now, there isn't enough. That reality overrides every macro model built on paper-era assumptions. So, here's your dashboard for tonight and this week. In approximately 10 hours, Shanghai opens. Watch the opening premium relative to Western spot. If it widens beyond $4, the physical market is reasserting price leadership. If it narrows below $2, the West has genuinely caught up and we're in consolidation mode. Over the next 3 days, watch the COMEX vault reports for registered inventory changes, metal flowing in signals preparation for delivery, metal flowing out signals tightening, and on Friday, first notice day tells us how many March longs are standing for metal versus rolling. If the recycler premium holds anywhere near $96 into midweek, the physical market is telling you the screen price is still behind. I said at the top of this video that silver at $86 isn't the story. The story is what happens when the world's largest physical market reopens and discovers that the West ran toward its price while it was sleeping. Tonight is the collision, and collisions in commodity markets don't produce gentle outcomes. Tell me in the comments what price you think Shanghai silver opens at tonight. Over $90? Under $88? I want to see your analysis, not your hope. Show your reasoning. I'll pin the closest call. If this breakdown helped you understand what's actually driving this move and what to watch tonight, hit the like button. It pushes this past the algorithm to reach people navigating these markets with data instead of drama. If you're not subscribed, hit subscribe and turn on the bell. We will be covering the Shanghai Open and the lead up to First Notice Day in real time this week. You do not want to miss that coverage. Share this with someone who saw the 6% candle and doesn't know what's underneath it. Give them the framework. Thanks for watching all the way through.